Okay, Assalamualaikum warahmatullahi wabarakatuh and good afternoon everyone. Welcome back to our advanced taxation class. After so long, right, I will continue giving lecture on topic tax planning. Yeah, so we're going to look into this topic, tax planning, and this topic will also be part of your final exam question. Alright, so I hope that if you don't understand any of the part that I'm explaining later, right, you have to stop me and ask question. Yeah. Actually, when talk about tax planning, right, so we look into the objective of the tax planning. More likely is that, all right, by the way, I have shared the PowerPoint, all right, in your Google class, but I'll be using the same lah. Yeah. All right, tax planning. So what is a tax planning? All right, so means that you plan, all right, for especially for individuals and company. So you plan your tax so that of course nobody wants to pay taxes given a chance, but you know that tax is an obligation. All right, it's your obligation to the government, right, to the country in order to help the country to run. Right, so most of the government's expenditure is actually financed by tax collection, right? So that's why you have to pay tax. And of course, when we talk about tax planning, right, we try to, the objective of why people do tax planning is actually to eliminate, right? If possible, no one, you want to have a zero tax liability. It means that, all right, when we talk about tax planning, you still do, all right, whatever is required, right? You still report your income, you claim your expenses, you submit your income tax returns, and then if there is any tax liability, you make the payment, right? The compliance is there. But what you do tax planning means that within the tax law, how can you eliminate? Eliminate means that you zeroize your tax liability. Or if you cannot zeroize, how can you minimize your tax liability? All right. And among the tax planning also, can we pay tax in the future rather than pay tax now? So that's a tax planning. Yeah. Eliminate. If you cannot eliminate, you try to minimize or you try to defer your tax. So it means that rather than pay this year, can I pay tax in the following year? Is that a way for me to do that? But remember that when we talk about tax planning, it's always within the ambit of the tax legislation. Yeah, so you have to know the tax laws in order for you to do tax planning, right? So when you do, for example, later, even if you have done your practical training, if you do that in tax, you know that normally, for example, big companies, yeah, for example, when I was with PricewaterhouseCoopers, right, I first joined after my graduation. I joined PricewaterhouseCoopers for several years before I joined as an academic at IIUM. So what happened is that for big companies, they will have separation of duties. So where, for example, during my time, it was 20 years ago, right? It's about 20 years ago. So what happened is that, it's more than 20 actually, yeah, 1997. What happened is that I have individual unit, all right, they call it as it could be a division, and we have a corporate division. All right, under the corporate division, you will have tax compliance. So most likely that if you have just joined, all right, then you will do compliance. So it means that compliance, we are referred to the job is actually looking into compliance issues, for example, submission of income tax returns, that installment payment, right? All these that you attend to your clients, all right? But the other section is that what we call consultant, right? Corporate consultancies, you know. So it means that you consult your clients how they can actually minimize their tax liability. All right, so that is, so in order for you to do compliance, in order for you to consult, all right, to do tax planning, you must be very good in your tax legislation, and you do that from the tax compliance punya activities. So once you are very familiar with the tax compliance, all right, you are very good in that, then only you are going into your tax planning or tax consultancies. So in terms of the practicality, that's how it works. But we're talking about smaller company, normally there's not so much of segregation of duties. So, but normally the junior staff will do the compliance, the more senior staff will do the both compliance and consultancies. Yeah. For example, if the company wants to go for a merger, right? So then what would be the tax implication to the company? So the consultant will advise the company how they can actually structure, all right, the merger. All right, for example, should you have company A and B become C or whatever lah. Yeah, so that is the consultant. So that part of the tax planning lah, because we try to minimize your tax exposure. Are you okay so far? Yeah, all right. Okay, when talk about tax planning, as I mentioned earlier, it has to be within the ambit of tax legislation. So how could we have, we try to eliminate, we try to minimize, but everything must be within the tax legislation. So it means that it's there in the laws, right? It's just that how to make use of the tax laws in order to benefit the taxpayer. When I say benefit the taxpayer, it means that how to minimize the tax liability, all right? So in this case, the law is still say that commercially justified to avoid invocation of anti-avoidance section. Section 140 by the RRB. So when I say that section 140, it always refers to the anti-avoidance section. So the 140 means that if RRB say that, okay, this action, or whatever the transaction taken out by the company, if the RRB says that that is for the purpose of tax avoidance or tax evasion, right, then that will impose section 140. So it means that you have the intention to evade tax. So that's how you say that we have the term tax planning, we have tax avoidance, and we have tax evasion. Right, so we're talking about evasion means that you clearly, right, intentionally, you do not want to pay tax. Either you do not declare your income, right, or you declare your income but not the right amount of income, or you claim your expenses excessively, not according to the law. So all this is tax evasion. When talking about tax planning, you do all that but within the ambit of tax legislation. All right, you still claim, you still report the right income, for example, but expenses you claim, but if you can claim more, then you can claim more. When I say more means that if you say that an expense, for example, if you can claim double deduction, you go for double deduction. Right? It's not that you want to claim excessively, but within the law says that, all right, this kind of expense, you can claim double deductions. So then you make use of that double deductions. But in order for you to use that double deduction, you must know the law. Right? So that's why we say that in order for you to do tax planning, you must be very well averse with the tax legislation. Okay? And then, of course, there are so many options for you, right, in order for you to reduce your tax liability. But of course, you have to choose the best alternative, yeah, that will provide the lowest tax and that will benefit the taxpayer. Yeah. Based on knowledge of tax legislation and RRB practice. So that is what we're talking about tax planning. Yeah. So for this topic, what we are going to do is that we're going to look at, all right, what are the areas that taxpayer can actually do a tax planning. Yeah. So when we look into, for example, most likely there could be a company lah, but some individual also can make use of this tax planning. But for individuals, not much tax planning they can do. I think that, all right, you're talking about tax planning. For individual, you know that this is your income, this is your expenses, and then you also have your relief and rebates. So how can you maximize your relief and your rebates? So that's the only way for tax planning, right? For individuals. But talking about companies, there are so many areas, all right, that company can look into in order to reduce their tax liability, right? Okay, all this topic, right, the one that I showed you here, you have actually done that. throughout your tax 1, tax 2, and even your advanced tax now. You have done all this, right? It's just that we are putting things together and see how we can make use of all this information, translate that into tax planning, right? So commencement of business, for example, you have done that in your tax 1, right? Then when you want to acquire your fixed asset, for example, if the company wants to purchase a machine, or when the company wants to purchase a motor vehicle, all right? So what are the areas that you can think of, all right, or you have to explore further in order to maximize your tax claim, all right? Or you want to maximize your tax deduction. Remember, at the end of the day, you want to pay lowest tax liability. So what are the areas that can reduce your chargeable income? Yeah, and then talking about disposal of assets. So what do we have? What are the issues we get to disposal of assets? All right, we're going to look into that also. And we have controlled transfer. So I think that I have not covered controlled transfer, but maybe I will just go through in this topic with regard to controlled transfer. And then we also have issues, topic with regard to business income and investment income. Yeah, so when if given a choice, of course, you want to do a business income rather than investment income. A very straightforward example is when you talk about rental income. Rental income is under section 4D, right? But can you make it section 4A? The same rental income, but instead of being assessed under section 4D, you want the rental income to be assessed under section 4A. So you have to fulfill the requirement. What are the requirements for rental income to be assessed under section 4A? Anyone? Comprehensive maintenance, something like not only maintenance, but you have to provide comprehensive service and maintenance. Yeah, so that will put your income rather than section 4D, it becomes section 4A. So when you know that, all right, why you want to put your income as section 4A, then you have to see what's the difference between 4A and 4D. Why is it 4A is better than 4D? So these are the things that you have to look into lah. Yeah. And then we're talking about interest restriction here. Remember last time, which group that presented in regard to interest restriction? I think that's a BAPS, is it? Well, what was it, BAPS or was it BAPS? Business expense. What is BAPS? Saya pun dah tak ingat dah. Mana group BAPS? BEPS. Ada BAPS ni, tak ada. Okay, tak apa. Alright. So interest restriction means that when you should remember that interest expenses is deductible against income, right? But the amount of interest deductible is restricted to the amount of income. Yeah, I think that under the one presented last time was it BAPS again? Mana? Tak keluar punya. Tak nampak. Okay. Alright, we go there into that later. Yeah, and then we have investment in the company. So means that if a company has extra cash, right? So normally they would put their money into investment. So when they want to invest, should they invest in a company? It means that they buy shares in a company, or should they use the money, extra money that they have, right, invest in a form of giving loan to other company, right? So which one is better for the company? So these are the things that you have to consider because it has a tax implication, right? And then we have group relief for loss. So it means that you have to understand the topic group relief because the structure of the company is very important in order for you to claim group relief. right? You have to fulfill the conditions, for example, the 70% ownership, yeah, so whether it's direct or indirect. So that is on group relief. And finally, for companies, resident status. And even for individual, all right, resident status is important because different tax treatment is given for resident individual, right? Similarly for resident company, yeah. For example, company with resident status, they can enjoy a lot of incentive given by the government, but non-resident company, they cannot, right? But for company, it's very easy to have a resident status as long as have the management and control of the company is in Malaysia at any point of time, then the company is a resident company. But for individual, the resident status is more challenging, where you need the section 71A, B, C, D, right? Where you say that 71A, you need to be in Malaysia physically for at least 181 days, right? Then if you don't have 181 days, can you fall under section 71B, where you say that you can be in Malaysia for less 181 days, but you must have a period where it's linked to another period of 182, 181 or 182 days or more, right, consecutively. So that is when you look into your resident status for individual, then you have the section 4C, then you have the section 4D. So these are the areas in your textbook, right? Your advanced taxation with regard to tax planning. But another topic that you can look for your tax planning, I'm not sure if I will have, all right, on chapter 41 is tax planning for companies. So these are the areas that we will cover. And then you have chapter 42 is on the reorganization. Yeah, reorganization, reconstruction, and amalgamation of companies. And then you have chapter 43 is on anti-avoidance. Yeah, so that is all related to your tax planning topic. Yeah. It's interesting, but I will have to go through this. So because the slide prepared here is only based on chapter 41. Yeah, I have not prepared the slide for 42 and 43. I will look into that later. Yeah, and then we only have topic tax audit and tax investigation to cover, and because that is also under your final exam. What else? Group relief done. Right, double tax agreement. Itu je kot yang kena cover. Yeah, alright. So far so okay? So always remember about what you're doing now, what you're trying to look into, all these, alright, following topics is that you're trying to look at how you can minimize your tax liability. Okay, we're talking about commencement of business, right? So this one is a revision of your tax one, but the implication is what when regard to tax planning. So remember that we talk about commencement of business is not the same as incorporation of business. So this one is for companies, yeah. So it means that even for individual with business income, yeah. So when you commence your business, so anything before commencement, or we call it as a pre-commencement expenditure, is not deductible, right? But once commenced, then revenue expenditure is deductible. So we talk about businesses. When you're the first year of business, normally you will only incur a lot of expense, but not so much of income generated. But it's okay because we say that, all right, if you have commenced your business, revenue is now deductible. So revenue expenditure here, you refer to what expense? For example, your employees punya salary, right? And then you have repair and maintenance normally. What do you have normally in the first year? Because talking about it's a revenue expenditure, right? All your capital expenditure is still non-deductible lah. Yeah, revenue expenditure, especially your wages, all this yeah. What else? Apa ya kalau start business, you can add the transportation cost, right? For example, the fuel, the maintenance especially. So all this is deductible once you commence your business. So commence your business, it doesn't mean that you must generate income. right? So commencement depends on the different industry. For example, we say that for a retail shop, right? So you will commence your business on the day that you first purchase your stock or your inventories. So the first day you purchase, then that will be your commencement date. So the tax planning here, you know that, okay, you have a cut-off period, you have the pre-commencement and commencement date. So you want to commence as soon as possible, right? So you must know your industry. So we are talking about a retail shop. In the law says, not the law lah, but the common practice, the commencement starts on the day that you first purchase your inventories. So once you purchase your inventories, that will be your commencement date. And from that date onwards, all your revenue expenditure is deductible, even though there is no income generated. You may first purchase your inventory now, maybe 2 or 3 months later, only you open up your shop, for example, yeah? So it doesn't matter when you open, but when you first purchase your inventories, that will be your commencement date, all right? So if no income is generated, remember that zero income, then you have all the expenses, then you have your adjusted loss, right? So instead of having income, you have adjusted loss. And this loss, all right, it goes back to you punya, mana I punya, right? It goes back to you punya understanding of computation of your chargeable income. So in order for you to do your tax planning, right, you must be very clear on the format of your chargeable income for a corporation, for example, right? Starting from adjusted income from business. So from arriving to this, remember that you have gross income minus allowable expense, yeah? So you have your adjusted income, then you have your balancing charge, capital allowance, then you have unabsorbed CA, statutory income from business A, and then you minus if there is any investment tax allowance and reinvestment allowance is here. So what you minus here is because statutory income here, you will compute the 70%, right? So that is another part, yeah? So you have your investment tax allowance, which is 60% of QE against 70% of your SI. So you have to compute how much is the investment tax allowance that you're going to claim that year. So you deduct that against your 30% of your SI. Right? Salah, 70%, 70, 30. Right. So that is the amount given. Yeah. And then you have statutory income from business B. Then you have the aggregate SI. So maybe this one should also be okay, aggregate SI, then only you minus your loss brought forward. All right, remember that loss brought forward is after your aggregate SI. Aggregate SI is your SI from A plus SI from B. Right, then you add your other sources of income, section 4C, 4D, 4E, and 4F. Then you have your aggregate income minus current year business loss, approved donation restricted to 10% of AI, corporate zakat, which is 2.5% of AI maximum, and then you have your group relief. Yeah. So if you have 30% of your, for example, if you're under pioneer status, then you have your 30% of deemed income. So all this must come together, right? Then you have total income, and then minus, see here is your double tax relief, your section 132 and section 133, right? Whether the relief is we call it as a unilateral relief or a bilateral relief. So you compute that here, then you have your tax payable amount, whatever paid by installment, then you have your balance tax payable upon submission of your income tax return. So all this formula, all right, in order for you to do tax planning, in order for you to consult other person, all this must be in your fingertips, right? You should be able to just compute or imagine how it was going to be, right? Then only you can do tax consultant, yeah? Okay, next is that For companies, all right, trading, for example, just now, hold on. Sales or turnover need not be present means that for commencement, you don't need to generate income, right? But the trading company, when embark on purchasing activities, so purchase means that you purchase your inventories. Yeah, sales is unnecessary. Manufacturing company, you will commence business on the production day. The first day that you produce your product, that will be your commencement date. So for companies, all right, if your hotel open its door to the public, it means that it doesn't have to have people to go for accommodation, but soft launch. What do you mean by soft launch here is that you just call some reporters, all right, you call some people, VIPs, just to soft launch, potong ribbon kan, so that is soft launch lah tu, right? So once you have that, then means that the hotel now has commenced. So once they have commenced business, then all the employees or the cleaners or everyone, all right, under the hotel now, the expenses that you incur, revenue expenses now become deductible. So why you need to know about commencement? The impact is that you know that once you commence business, revenue expenses is deductible. So that's why you want to commence as soon as possible, right? If you do not know this, all right, you may just wait until forever to commence your business. And whatever expenses that you have incurred all this while without being commenced, then you cannot claim that expense as a deductible expense. Okay. Okay. I need to give me 5 minutes. I need to charge my laptop. We take a break, yeah? For what? Banyak pula. Nak tengok, this is my findings ah. Just to share with you, yeah? Findings on IUM students, not IUM lah, Department of Accounting students in this semester during this teaching online learning. All right. Any one of you have this problem? Tak ada. Betul lah BEPS eh. Is it BEPS? Semua kena. Semua Yang paling banyak yang mana? I think overload dengan too much ni, I think is the same lah. Right? You ada problem dengan lecturer you tak? Lecturer yang kat depan ni. Terlambat lah, dah terlambat kalau ada problem pun. Nak buat macam mana? Course content. Screen time, too much screen time. Loneliness. But not many actually. Okay, coming back. Baik lecture semua bagusnya. Okay, so where were we? Here, alright. So just now we talk about commencement of business, right? The issue here, number one is revenue expenditure is deductible upon commencement. Number two is that if you were to have capital expenditure, right? capital expenditure can only, you can remember capital expenditure means that if you were purchase to your fixed asset, all right, for example, you're talking about trading. So all the shelving, the cabinets, the air conditioner, the lightings, all that is your capital expenditure. All right, so once you commence your business, then only you can claim your capital allowance on your capital expenditure. Right, so again, it goes back to the date of commencement. So if you want to apply, if you were to purchase too early, right, before commencement, then you cannot claim. But remember that the asset depreciate over time. So try to commence as soon as possible, then purchase your capital expenditure, right, or purchase your capital asset, then you can claim capital allowance immediately. And remember that even though you have zero adjusted income, remember there's no income, you may making adjusted loss because you zero income minus allowable expense, right? All the revenue expenditure is deductible. So you have adjusted loss. So even though you claim capital allowance, but your statutory income will be zero because capital allowance here will be carried forward, right? You are not going to utilize your CA, but you're going to carry forward your CA to the following year. Right, and the following year when you first make income, for example, the first year that you have adjusted income, remember that you have accumulated your capital allowance. So that capital allowance brought forward can help to reduce your statutory income. Or maybe it may absorb all your adjusted income, so you have a zero statutory income, right? So that's why I say that you must be very clear about the format of the capital of the tax computation so that you know how to make use of all these allowance and expenditure. Yeah. So when talking about capital allowance, right? Not only on commencement, but whenever you purchase your capital allowance, whenever you purchase your capital asset, all right, start to claim your capital allowance. But remember that the capital allowance is only available for business source section 4A, right? So if you have a rental income, right, you put in all the cabinets, you put in your air conditioner, TV, for example, is a fully furnished rental, for example. So if it's still under section 4D, then you cannot claim capital allowance on those assets. So you have to structure it to be section 4A so that you can claim all allowances on your capital asset, right? And remember that for you to claim capital allowance, asset must be owned, all right? You incur the expenditure and the asset must be in use in the business. Yeah, you cannot put that asset aside. It has to be used in the business, then only you can claim that capital allowance. And the capital allowance is set off against adjusted income, right? So if you were to look at the format again, talking about capital allowance, right? Capital allowance is made up of, right, your unabsorbed CA brought forward, right? Means that if you have CA in the previous year which is not utilized or not fully utilized, you carry forward to the current year. So that is will be available as part of your capital allowance. And you also have your current year capital allowance. So you have to compute your IA and AA, all that. Yeah, and then your balancing allowance. So balancing allowance, what is a balancing allowance? Anyone? What is a balancing allowance? And now, Katani, or the balancing charge? Anyone? Balancing charge and balancing allowance. When will you have that? Yeah, upon disposal of your asset, you will have balancing charge and balancing allowance. Yeah, when your selling price is less than your RE, then you will have balancing allowance, right? If your selling price is 100, but the residual expenditure is 80, then you have a balancing charge. In other words, this is a gain or loss on the disposal of asset. The difference is that the computation of the residual expenditure is different. Yeah, the computation of the depreciation. So for example, you're talking about accounting, it's just like a straightforward 10% depreciation per annum. All right, but for tax, all right, you have to compute the initial allowance, the annual allowance, then you come to your residual expenditure. Yeah. So, but what is balancing charge is actually a gain on your disposal. Balancing allowance is loss on your disposal. So allowance always refers to deduction. So balancing allowance is given as a deduction. When we say charge, it's always chargeable. So it means that you have to pay tax on that. So it makes sense lah. Kalau you balancing charge, mean that you make a gain, then you have to pay tax on that gain. Yeah. But you're talking about allowance means that given as deduction because it's a loss, it's an expense. Okay. Any unabsorbed CA can be carried forward to future years to be set off against the same business income. So remember that, all right, when it goes to a more advanced, advanced taxation, right? So if you look into the professional exam paper, right, sometimes they do have this scenario whereby a company has businesses and then whether they want to diversify, right, or they want to create another business source. Yeah, because if they have that, then the CA cannot be transferred from one business to another business, even under the same company. So you can have business one, business two, and the same company, but the CA for business one can only be used against business one. CA for business two can only be used for business two, right? You cannot macam group relief lah kan? No, there's no such thing. Yeah. And then it says that because of that, try to structure various business activity, right? Kata business activity to be one source of business income. All right, so they will do a test of interconnection, interlacing, and what we call interdependence or unity, all embracing those activities. So for example, you have a business of mineral water. Okay? Business of mineral water. And then you want to expand the business activity into what ice cubes. All right. Can you put that business of mineral water and business of ice cube as one business source? Yes or no? Do you want it to be under one business source or you want it to be a separate business source? You want it to be business one only, but you want it to be business one and business two. Which one is better for the company? Same, Tamil. Yeah, you want it to be under the same business source, right? So how you can argue? You can argue that the business of your mineral water and the cube is interrelated. All right, clearly you see that in order for you to do ice cube, you are going to use that mineral water. Of course lah, not mineral water in the bottle lah. All right, the source of the water lah, the mineral water. Yeah, so you use the same source. It's just that one is that you put that into bottle, the other one you put become an ice cubes. Yeah, so you can put that under one business source. But how can you show that this is it should be under the same business? Of course, that is based on your justification. Alright, if RIB, of course, kalau RIB dia nak you, of course, RIB kata, oh, it should be separate source. Because why separate source means that most likely you have to pay more tax. Alright, but if a single source, then you can absorb whatever CA that you have within the same. Yeah, so that's why it's all about justification. In the professional exam, the question is normally given a scenario and then you have to justify whether the business can be set as a one single source or the business activities, and then you have to justify. All right, and then you have to talk about the tax implication when the business is under one source or the activity is under two sources of income. Asal. Okay. right? Okay, we talk about initial capital allowance, right? Generally, we have IA at 20% and AA at 10%, 40%, and 20%, right? But when you talk about tax planning, of course, this one you dah tahu dah. IA and AA, generally, that is the rate. But you must be also aware of what we call accelerated capital allowance. Any idea what is accelerated CA? What do you have? Accelerated CA. Pernah dengar tak? ACA. Ada lagging sikit ya. Tak ada ACA. What is ACA? Fixed percentage. Yeah, it's fixed but apa maksud accelerated? What do you mean by accelerated here? You know that you have IA, normally it's 20%. AA is either 20%, 14%, or 10%. That's the category. Right? Whether it's a motor vehicle ke, whether it's a heavy machine ke, more capital allowance in the early years. Right? I would say it like this. When you say that accelerated SCA, it means that the initial allowance or the annual allowance could be higher as compared to the general IA and AA. So for example, we talk about accelerated CA, kalau IA dia normally 20%, under ACA, the IA is 40%. Right? Or katalah AA normally is 10%, but because it's an ACA, then the AA is 20%. So it's higher. Right? So is it good to have a higher IA and AA? Is it good to have higher or lower CA? What happened? So if your current year, we're talking about your current year capital allowance here, right? Because this is where you compute your IA and AA. Yeah. So if what happened if your IA and AA is higher than the normal one? The implication is on your statutory income. Right? So it means that if you claim here higher, what happened to your statutory income? Statutory income will be lower. Yeah. So what happened if you lower? What happened to your tax at the end of the day? Tax will also be lower. Yeah. So that's why for income tax, remember the objective is to minimize your tax liability. Yeah. So if you can have the option to claim a higher capital allowance, why don't you go for it? In order for you to go for a higher capital allowance, you must know the law. Which asset that you can claim higher capital allowance, right? So for example, alright, where we have, I think the ICT ni dah tak applicable lah. Right, I think ICT now goes back to, what's the rate for ICT? I think it's 10% lah sekarang. Yeah. So these are some of the accelerated capital allowance. For example, if your company were to purchase, nanti I nak refer balik textbook, page, kat mana tak? Hold on, yeah, we look into the textbook on page 452, right? So 452 page 2.2, so you have the list here. You nampak ke tak? Right? Okay, the textbook, they give you list of, so my slide here may not be updated. I forgot to update this slide. So ICT equipment now is 20 and 20. Right? So previously, the ICT equipment, it was 20 and 80%. But now, they have, I buat apa ni ya? sikit. Mana dia tadi? So not, is 20 and 20. So, right, whenever you have ICT equipment, then you claim lah 20 and 20. Generally, it should be 20 and 10% because, for example, if you purchase computer, you purchase printer for the company, alright, it's a office equipment. Office equipment normally is 10%. But because the government says that, oh, for all these expenditure, you can claim a higher CA. So that's why you should go for higher. So kalau you claim 10%, it's wrong lah. Right? It's wrong. It's right, but it's wrong. Faham tak? It's right to claim 10% for the RB, but it's wrong lah. But that is not the best option that you should go for. Right? You should go for if there is a higher capital allowance given, then you should go for it. Right? And then ICT equipment is 2020. Automation equipment. Do you have automation equipment? It's not here. Right? Automation equipment is 20-80%. So katalah, contohlah I letak kat sini ya. What is it? Let's say it's now ada tak automation, tak ada. Automation equipment is 20% and 80%. And that is effective from 2000. This one to be 2015 until 2023. Okay. You get that? All right. So when you have automation equipment, so whatever company purchase automation equipment, give me an example of automation equipment for a normal company. Automation. Apa ya? Work time, yang punch tu, is it? The punch, you have to punch in, punch out tu kan? That one is an automation. So previously, maybe you have to write down your name, for example lah, but now you just have the puncher tu kan? Punch in, punch out tu. For example lah, that is an automation equipment. So if you were to purchase this in 2021, then you should claim 20% and 80%. So what's the implication of 20% and 80%? What's the implication of 20% and 80% in this first year? Initial allowance, you claim 20%. Annual allowance, you claim 80%. What does it mean? 100% in the first year. Right? Means that whatever you incurred in the first year, you're going to claim everything in the first year. Is it good or bad? Good. Because why? If you were to claim a lot, alright, means that first year tu you dah claim everything that you incurred, then your SI will be reduced lah. Rather than you claim, kalau your normal rate is 20 and 10%, so first year 20 and 10, and then second year 10%, 10%, 10%, 10%. You need 7 years to claim the expenses. But given the ACA, rather than you have to wait 7 years to fully claim the expense, you can claim that in the first year. So bila you claim first year, remember that bila expense kita nak claim as soon as possible. When you talk about income, you want to postpone as much as you can. Remember that. If you were to receive an income, possible tak you nak postpone? But if talking about expense, you want to claim as soon as possible. If you can claim this year 100%, claim everything. Yeah. So that's why if you are not aware of this ACA, right, you will claim 20 and 10% lah. Kalau you claim 20 and 10%, correct. Alright. But it's wrong lah. Boleh tak? Correct but it's wrong. Correct because there is a law that says that okay, the normal law is 20 and 10%. It's wrong for tax planning. Because you can actually claim 20 and 80, but you claim 20 and 10. So in your answer, it's wrong.
Not smart.
Of course, RIB prefer you to claim 20 and 10 because you have to pay higher tax for the year. But as a taxpayer, I want to claim as much as you can so that I pay the lowest tax liability. You get me? Right. So that's why I say that in order for you to do tax planning, you must be very good in your compliance. Then you must know your tax law very well. Right? Because if you know, then you can claim a lot more for your clients. All right. Other than automation equipment, we have they give details. For example, manufacturing company in labor-intensive industry. So rubber, plastic, wood, textile products. So I remember now. Remember the big company now. With regard to this COVID-19 ni, Kaizon, apa lagi satu the big one? Top Glove. So they all this in the rubber, plastic, wood, textile and industry tau. So they are actually making a lot of revenue now. Income is very high, but all the expenditure for the automation equipment used for the product is now they claim 100%. Yeah. So not only they get a lot of revenue, they lowest tax. Right? So it happened that they are in that business, right? Rezeki namanya. Yeah. All right. And automation equipment in manufacturing company in other industries can also claim that. Plant used for carrying out petroleum operation in a marginal field. So the rate now is very pelik, yeah. Why? Because the initial allowance is 25%, annual allowance is 15%. Pelik kan? 25 and 15. I pun tak pernah dengar. But that was since 2010. Ha ha ha. Okay. 2010 until 2024. And then we have renovation costs incurred on a building or part of building in tracks. Yeah, tracks, marquee, status company, 20-40%. So you have all these higher, you know, the IA 20%, or if you look at the precast concrete molds used in the production of industrialized building system component, the IA is 40%. So 40% is higher as compared to normal IA, which is 20%. So if you are in this industry, then you should claim for a higher tax rate, or not higher tax, a higher capital allowance rate. Yeah, IA and AA. So these are, they give you the list of, the table give you the list. I think that, for example, which one is more applicable to us, yeah? Recycling waste, plant machine used for recycling or further processing of waste, pollution control equipment, right? Plant and building in the building and construction industry is a IA 30%. Plant and machinery in mining and timber industry 60% IA. Tapi dia tak ada annual allowance. So maknanya the tapi that was in 1998 onwards lah. 60%, so dia tak ada IA ya. So rugilah juga because dia boleh claim 60% only. But it's okay. Alright, imported heavy, alright, 10-10. Or bus and natural gas. Natural gas refilling equipment, 40%. Okay. I want you to look, are you looking at the textbook, some of you? Okay, I want you to refer to page 5454. Alright, item number QR. Yeah, you have small value asset, small value asset. Right, small value asset ni is still a capital expenditure. Right, but it's just that because the value of the is capital in nature, but the value of the asset is small. Right, in this case, it's less than 1,300, but up to 2019. But in YA 2020, the value has increased any asset which is less than 2,000 ringgit. Right, so is a value is, for example, you talk about a company purchase a microwave, right, for their staff use. Microwave, all the small items, TV, boleh TV less than 2,000 boleh, yeah. Alright, you buy for your office, all these small value items that will last for more than 2 years. Alright, so all these you can claim capital allowance, and the CA is 100%. So it means that in the first year, you claim everything. Yes, claim everything. But you have to make a difference from the other asset, what we call replacement asset. All right. It's an asset, right? It's a capital asset, but the nature is that you need to replace the asset now and then. All right. For example, you're talking about a business in a restaurant business. You're talking about hotel business. So let's look at the restaurant. For example, all the utensils, all right, you have to replace that regularly. Maybe on a, it could be monthly basis, it could be quarterly basis, but regularly in a year. All right, so this is what we call replacement asset. So when I talk about replacement asset, the tax treatment is that the first time that you purchase the asset, you cannot claim, right? It's an initial expenditure. You cannot claim capital allowance because it falls under replacement asset. No capital allowance, but the first year, the first time you purchase because as an initial expenditure, is a capital in nature, you cannot claim. But in the following, whenever you replace those assets, upon replacement, the expenditure is a deductible expense. So when I say deductible expense, it means that it's a deductible expense too. Is a, you don't claim CA, but expense too you claim as a deductible expense. Which one is better? All right, given an option, you can claim 100% on the asset as a revenue expenditure, or you want to claim the asset 100% as a capital allowance. You tell me, which one is the better option? Nak claim as a revenue expenditure 100%, or you want to claim capital allowance 100%? Capital allowance? Anyone else? Capital allowance juga, CA juga. To me, alright, going back to tax planning, I will claim as a deductible expense. Claim as a revenue expenditure. Why? The impact is on the adjusted income terus. Kalau CA, impact is on the statutory income. Nampak? I want to reduce my adjusted income as much as possible. Alright, so bila I dah reduce my adjusted income, it's the same amount kan? 100%. So I dah buat ke atas the adjusted income. What happened instead of having adjusted income, I have adjusted loss. What happened to the loss? So that's why I cakap, your format memang kena ada dekat fingertips je. What happened to adjusted loss? Carry forward to where? No. You don't carry forward your loss. What you do first? Adjusted income, but now I have adjusted loss. Deduct against aggregate income. Very good, Amir. Right, whenever you have adjusted loss, right, you will use the losses to further reduce your aggregate income. The loss is from business, but that loss can help you to reduce income from other sources. Can you do that with CA? Let's say that your income is 0. Your CA, you kata you claim 100% CA. Of course, you do not utilize that CA, yeah? You carry forward the CA to next year. But can the CA brought forward used against other income source? Tak boleh. Right? Not only other income source, other business source pun CA tak boleh. You cannot use your available CA against other business source or against other source of income. But if you have adjusted loss, the adjusted loss can be used against your aggregate income first. If you still have balance, then you can carry forward to be set off against your aggregate statutory income. Can you see this? Right? So what I'm talking here is that when you have these current year business loss kat sini, mana ni ah? Shh. La ilaha illallah. I nak tunjuk apa ni? Tak ada keluar dia punya. Mana dia punya tu? I nak buat color-color tak boleh. Mana dia? Hilang lah. I don't know where it is lah. Right? So this current year loss will become unabsorbed loss brought forward in the following year. Betul? Alright. So the loss ni you can set off against business 1, business 2 because why? Aggregate SI. So that make a difference. Yeah. So again, if I were to ask you again next time, if you can claim as expense, claim as an expense, deductible expense. If not, then only you claim against your capital allowance. Yeah, so that is a better option because a revenue expenditure will immediately reduce your adjusted income, or if you don't have any enough income, then it becomes adjusted loss. Adjusted loss can be set off against your aggregate income, and if it's not fully utilized, you can carry forward to next year to be set off against your aggregate income. Got it? Right? But capital allowance 100%, you can set off against your adjusted income. But if you don't have enough adjusted income, of course the CA can be carried forward to next year. Good. But the carry forward CA can only be set off against the same business income. It makes a difference there. So this one is not updated. Alright, then, alright, the next topic is on the financing arrangement. Are you okay so far? Any question before we go to the subtopic? Financing. Okay, whatever I have explained just now, we got to the CA, right? It's on 2.4, right? Page 454. No question? Can I move forward to the next topic? It's on a financing arrangement.
Doctor, I have a question. Yes. Can the company choose whether they want to follow the ACA or the normal capital allowance?
Hold on, yeah. No, you cannot choose actually. All right. But for example, talking about the asset, all right, the asset is on a replacement basis, then it will be a revenue expenditure, right? Can you choose? Hold on, let me check. No, you cannot choose. But what I want to emphasize here is that you must understand the difference between deductible expense and capital allowance and their implication. Is that okay? You have to know the different treatment between deductible expense and capital expenditure that you claim capital allowance. Okay. Later we'll see that, for example, another example that I give you is that talking about section 34. Right? There are some donation or contribution that you can claim under section 34 or section 44. Right? Section 34 or section 44. Example is that I say that, okay, contribution to a library, that amount of 120,000. Okay? Or let me say, okay, let me make it 80,000. Like contribution to a public library amounting to 80,000. Okay, now, right, so that contribution of 80,000, right, it appears as your expense. The issue here is that you can claim the donation here, right, under section 34 or section 44. Which one you want to claim? What's the difference between 34 and 44? This is tax planning. Yeah, section 34 because section 44 got limit. Yes. All right. Because it restricted to how much? 20,000. Correct. Yeah. But what would be the implication is that if you were to claim against your section 34, so you'll see that you claim in arriving to adjusted income. So you claim 80,000, so that will immediately reduce you punya adjusted income because you claim 80,000. But if you were to claim against section 44, what would you do? Kalau nak claim section 44, it means that against your aggregate income. So you have to add back 80,000 and claim against your aggregate income 20,000. You see that? So now you will see that, of course, kat sini you boleh claim 80,000, but if you claim under section 44, you can only claim 20,000. But if I was to say that, okay, I donate 20,000, sama. So 20,000 will reduce my adjusted income 20,000 under section 34. But if I were to claim under section 44, I will have to add back 20,000. Then only I claim against aggregate income. Is that good or not? Which one is better then? Assuming that it's 20,000, the same amount. Which one better? 34 or 44? Still is 34. Why? Because 34 will immediately reduce your adjusted income, right? And assuming that the company do not have enough income, then it will increase your adjusted loss. So bila ada adjusted loss, cerita dia bagus lah. It's not that I'm saying that it's good to have adjusted loss. It's good for company to have losses, no. But when a company is in an adjusted loss position, then you can use the losses to set off against your aggregate income, or you can carry forward to be set off against your future aggregate SI. It always goes back to that fundamental. Yeah, this one we talk about the same amount of 20,000. Why is it that I say that 20,000 section 34? Katalah you punya income is zero, right? So you have adjusted loss. But if you say section 44, right, katalah your aggregate income is zero, that 20,000 tu you cannot claim because the amount that you can claim is restricted to 10% of your aggregate income. If aggregate income is zero, how much donation you can claim? How much can you claim? Kalau aggregate income is zero, donation ada 20,000, can you claim? Cannot. Yeah, you cannot claim. So, rugilah. Nampak? So, that's why kalau boleh expenditure, claim as soon as possible. Kalau you boleh claim at the upper level, claim at the upper level first. Yeah, so that's why section 34 and 44 plays a very important topic when talk about tax planning. You must really understand your section 34 and section 44. Yeah, whatever you can claim under 34, claim first. Right, so itulah. Right. So that one is bukan tajuk ni ya. That one is under understanding of your losses. Yeah, business income and non-business income lah. Okay. Okay, talking about this financing arrangement. Ish, boleh. Okay. Financing arrangement means that if you were to acquire an asset for the company, right? You want to purchase an asset for the company, then you have to think of whether how you are going to purchase the asset. Because why? When you want to acquire asset, it will affect your cash flow, right? Whether you pay, for example, whether you buy cash ke, or you go for term loan, or whether you go for hire purchase, or you go for leasing. So that's the methods available. Of all these methods, it will affect your cash flow. For business, cash flow is very important. Right? For business, you want to minimize your cash outflow as much as possible. Yeah. So you want to minimize your cash outflow. And then of course, when talking about asset acquisition, you have to determine how much CA that you can claim. And that CA that you claim depends on the methods of financing. Whether you go for cash or term loan, hire purchase or leasing. Yeah, and then on top of that, you must also consider the interest expense. Right? For example, if you pay wholly in cash, there's no interest expense involved. But if you go for term loan and hire purchase, there will be interest expense. And how is that interest expense treated? Right? What is the tax implication of your interest expense? Okay. So these are the things that you have to consider. Alright, normally the question would be, you have to compare. Alright, given a scenario, company wants to purchase a machine, right, or an asset for the company, and then the option is A and B, for example. You want to go for term loan or you want to go for hire purchase, right? Then you have to advise the company what is the tax implication of these two options. Then you have to advise which one is the better option for the company to go for it. Nampak tak? Okay. Alright. When talking about wholly in cash, it means that if you were to purchase a machine that costs you 100,000, you pay 100,000 in cash for the machine, right? So in that case, all right, can you claim capital allowance on the machine? Yes or no? Can you claim capital allowance on the machine? Yes. Yeah, what's the rate? IA could be 20%, and let's say it's a, okay, machine kat sini, kalau dia kata machine macam tu, it's going to be 14%. But if it's a heavy machine, then it's going to be 20%. Yeah, so the rate will be IA 10%, IA 20%, AA is 14%. So normally, because you have to compare between term loan and hire purchase, right, that, or maybe you have the option of pay by cash, so you have to look at the different treatment here lah. Alright, so kalau term loan, then means that the qualifying expenditure is on the 100,000. Then you have IA and AA, then how many years? For example, let's say that you have to compute for 4 years period. Alright, so the term loan is only for 4 years, then how would it be lah? So you have to compare apple to apple. Compare purchase of equipment or machine on hire purchase, or in this case term loan dengan hire purchase. Because hire purchase, the competition is different. Yeah, so because the computation of the capital allowance for hire purchase is different from the term loan. How many of you are not confident about the computation of hire purchase? Or you are well aware of the computation? Kalau yes, then I don't have to revise. If no, then I may have to revise how to compute. Okay, if I kata dia remember. So if anyone have problem with, boleh tanya Ifa. Ashraf boleh tanya Ifa. Dengan Pang. Right? Boleh Ashraf? Alah. Okay. Alright, next class we'll look into this lah. Right, sekarang pukul berapa ni? It's the time already. 5:60. Okay. We look into the different computation between term loan, alright, or cash or hire purchase. Okay, we're talking about leasing. Okay, you have to understand lah. Bila term loan ni, what happen is that, alright, still the machine costs you 100,000. But what you do is that you take loan from the company, from bank, right? So you have to pay installment payment to the bank, right? You have to pay to the bank for a several period of time. So the term loan is plus interest, right? So, but you have to see that how much is the qualifying expenditure. Is it based on the term loan, or is it based on the amount that you pay during the year? Yeah. So term loan is always on the QE is always on the total amount, the 100,000, for example. Yeah. But the interest incurred, you can claim that as a deductible expense. But hire purchase computation is different. Hire purchase means that, okay, 100,000 you have to pay deposit first, and the balance you have to pay over several number of installments, all right, for several years, for example, plus interest. Yeah. So when you want to compute the CA, it has to be based on the amount incurred. Right? So first year, how much you pay for the hire purchase. So that will be your qualifying expenditure. So the percentage of IA and AA will be based on that amount paid during the year. Right? So the computation is different as compared to the term loan. Leasing, all right, when we talk about leasing here, we talk about lease rental. Right? Lease rental means that rather than you purchase the machine, you go under leasing. So you just pay lease rental to the company. So the machine does not belong to you. It belongs to the lessor. So we have lessee and lessor. But in this case, we're talking about operating lease, not financing lease. Yeah. Leasing here, lease rental, it means that you just pay rental on the machine. If you have any problem or issues with the machine, then the lessor will come and help you to for the maintenance, everything. Yeah. So lease rental that you pay, whether for your machine or for your motor vehicle, is given as a deduction. Except that lease rental for motor vehicle, that's a restriction. All right, the amount of lease rental allowed could be 50,000 or 100,000 maximum, depending on the cost of the motor vehicle. Right, so that is on leasing. So you're talking about financing arrangement, you must know your qualifying expenditure under each term, right? IA, AA, and interest payable, and the timing. Right, the timing also make a difference. So we'll do this. Okay. How are we going to do this? What is the time now? 5:20. Let's take a 5 minutes break before we go into this topic. I'll do some calculation. Right? So let's take a 5 minutes break.